All right, good morning. We are ready to get started. We are so excited to have our favorite lender partner, Gianni, here to help us out in these tough times with these buyers so we can give them great options and make sure we can still get them in these houses, because they're not buying houses because of the interest rates and prices. They're buying it because they need this house. They're downsizing, they're upsizing, they're relocating. So we got to be able to offer them all the options that we can. So take it away, Gianni.
Thank you so much. I appreciate it. Thank you guys for allowing me to come on your call this morning. Hope everyone had a great holiday weekend, and wanted to personally thank each of you that have worked with me and allowed me the opportunity to work with your clients. I greatly appreciate it. Hope to continue to develop better relationships and keep working with you guys. And part of that is bringing you information on how to get around objections. We saw a huge market shift just a couple months ago where buyers were, they couldn't come fast enough. Now everyone's shifted to what I would say a temporary buyer's market in most areas. Some areas are still, pretty high seller's market, but for the most part, we're seeing a shift. Exactly what Alicia said. Everyone's a little afraid about these interest rates. So that's the number one objection that people are dealing with is affordability. It translates into interest rates, it translates into payment, but at the end of the day, we can summarize it as affordability. People are having a hard time digesting the cost of what it takes to purchase a home. So what I wanted to come on and share with you guys are a few different things and tools that we have here at Homebridge. We're helping not only buyers, but also sellers get rid of property, because obviously the challenge if you have listings right now is try to unload that property and how to figure out how to market it properly so that you can engage a buyer and get them off that affordability issue. So first thing I wanted to share with you guys here is something that the head of our builder department sent out right before Thanksgiving. And I thought it was pretty powerful because of just it's a quick kind of snapshot. Can everyone see that? It says buying a house.
Yes.
So take a look at this and, tell me how much this resonates with you. So if we turn the clock back, go 6 months ago, right, and we looked at a house that was listed for $450,000, more than likely after a competition war, you ended up usually about $50,000 over. So your sales price would end up being $500,000. So if we were doing a conventional loan with 10% down, the average interest rate during that time was about 4.5%. So this would be their principal and interest payment, $3,028. Okay, 4.5% interest rate. Everyone would be salivating over that today, right? So let's fast forward to today's market. Today's market listing price $450. More often than not, when you're negotiating a deal, you can get the price down to $425, because that's what most buyers are doing. They're coming down now. Or excuse me, sellers are coming down now. So if we use that same loan, conventional loan with 10% down, and your rate's at 6.5%, your payment's only $3,053. So what is that? We're talking about a difference of about 25 bucks. That's nothing, right? That's nothing. And these are the examples that you have to show your client, or let me show your client, because nobody really understands affordability out there. Buyers are spooked by fear, right? So our job as professionals is to take that fear out of them by showing them facts. And the numbers don't lie. They speak the truth, just like my example here. Well, another thing that we have rolled out, and you've probably heard a lot of people talking about temporary buy down. The most popular one right now is the 2-1 buy down. So I have an example I want to show you, but I want to first tell you about something even more exciting than a 2-1 buy down. We actually offer a 3-2-1 buy down that we just rolled out a week ago. Now, it's exactly what it sounds like. It allows the buyer to be able to get a rate 3% below the market rate for the first year, then 2% below the market rate for the second year, and then the third year, 1% below market rate. So that gives them 3 full years without being at the current market rate. Now, the objective and why temporary buy downs have become important right now is because everyone knows pretty much that rates are going to come back down again. Getting into market talks, we can talk about that in a little bit, but objectively, rates are going to start coming down once inflation starts to pay itself. That's a kind of a high-level overview. So as we start to see rates come down, more than likely in the next 6 months, anyone that buys between now and within the next 6 months, more than likely going to refinance. So what we have to do as professionals is we have to find out what their biggest pain point is. Is it the fact that they're paying too much right now? Are they expecting a pay raise in the next year or two? Do they want to gradually get into their payment? So the buy downs on two levels, whether it's a permanent buy down that permanently buys down the interest rate or a temporary buy down like the 3-2-1, it gives them different options. So I wanted to show you kind of an example of how concessions can really help change affordability, because that's ultimately the market we're in right now, is where buyers have the ability to negotiate sellers paying closing costs. We see builders are starting to throw crazy money at it, right? But what does that actually mean to the buyer? Because I can say, okay, great, this builder's offering me $20,000, but how does that actually help me afford my home? So, I would say the most normal reaction is about a $15,000 drop in price. If someone, if you're a listing agent and you're not seeing the house move at all, probably gonna, make a move about $15,000. So if we look at here where it says the option number 1, 3-2-1 buy down, we're gonna compare a 3-2-1 buy down to a straight permanent buy down and a price reduction, because those are pretty much the options that most buyers look at, is these three different options to help maintain their payment. So if we're looking at a price of $425, which is a little bit above, I would say the average house price in Georgia, with a 5% down payment on 30-year conventional, a 3-2-1 buy down costs about four points. Okay, so it's about $18,400. Okay, so it is expensive. Good.
Quick question. Two things. Well, there's like a little bit of feedback or something, like an echo on your end.
Really?
Am I the only one that hears that? Is it me? You hear it too, Patricia?
I hear it too.
No?
I do.
You do?
I don't hear it.
Okay, good. Okay, so if y'all don't hear it, that's great. When you talk about points, can you explain like when you say 4 points, what is 4 points?
Right, so great question. So 4 points, and we'll dive deeper into this in just a second, but 4 points is 4% of the loan amount. So 1 point is 1% of the loan amount. So if my loan amount, just for easy numbers, is $100,000, 1 point would be $1,000. 4 points would be $4,000. So in this example, our loan amount, if it's 95%, then our loan amount's $403,750. So 4% of that is roughly around $18,400. It's a little bit more than 4 points, and I have an actual calculator graph that I'm going to show you the breakdown, because there's more than just the 3-2-1 buy down. I'll get into that in just a second, but it's basically a cost that is endured, and with a temporary buy down, the seller has to pay this, and you'll understand why in just a second. So with a temporary buy down, the seller has to pay for it. So that's why these are only really relevant if we can get sellers to pay closing costs. But if you look at this example, okay, just off the top, the monthly savings in the first year is $754 per month, and a total savings of $9,048 in the first year. So if we come down here, this is based on current interest rates. If they have, a 740 credit score, 6.875 is our par rate. That would be our starting rate with no cost. Okay, so that would mean the first year they're 3% below that at 3.875 at 1898. That's just principal interest. The next year they jump up to 4.875. The next year they jump up to 5.875, and if they stayed in the loan, the remaining term of the loan would be at 6.875. Now, what do you see here? The cost is similar to the savings. Why? Because what a temporary buy down does is it buys out your interest rate for that 3 years. Basically meaning the seller is paying for that lowered payment for the first 3 years. That's why the savings is going to match the cost. This is great because in this first 3 years, it gives the buyer the opportunity to refinance once rates hopefully dive into the 5s. And it gives them that ability to save a ton of money in the first 3 years that they wouldn't if they were at a 6.875. So it gives them that flexibility to not only get into the home, but not have to worry about rising prices, so they can start gaining equity, and then they can gradually soften the blow of the payment going into it. So in the same example, if they were to use $15,000 to do a permanent rate buy down, that means the rate is bought down for the entire life of the loan for 30 years. Using $15,000, okay, you'd be at 6.125. So it looks like a big spread between 6.875, but it's only $196 a month. So it doesn't give them a huge benefit. It gives them a benefit, but not as much as the 3-2-1 buy down. Okay. Now, if we were to reduce the price, it's even worse. From $425 to $410, they're only saving $69 a month. And that's what we really need to tell the client, right? So this is how we sell. If we go back up to here, this green part, because all these numbers, that's a lot, right? It's probably a lot for anybody to digest and figure out what is this all really mean. So here's what we come down. We break it down to a simple level. Basically, what it's saying is the 3-2-1 buy down saves the buyer almost $750 a month compared to a straight buy down or price reduction. This means the buyer can purchase a home for $425,000 and get the same payment for a house that costs $304,000. That's the selling point.
Wow.
Right? Now you've got the client thinking, because they're all based, when they first start shopping, they're looking at price. That's the first thing that a client starts to look at. So they have to have this translated into a language that makes sense to them. So if you told a client they could buy a house for $425,000 in the first year, they could have a payment for a house that's in $304, that's going to resonate with them, right? Because all the rest of this is mumbo jumbo. It really is. I mean, some people can digest it, but for the most part, it's going to go in one ear and out the other. This sticks. Yes.
So the 3-1 buy down is it 3% the first what is it? You said 3%?
It's 3% below the market rate for the first year. So if they locked in at 6.875 in this example, their first year would be at 3.875, right down here. Second year would be at 4.875, and then the third year would be at 5.875, and then the fourth year, the remaining life of the loan, they will return back to that 6.875.
Okay. They're saving 3% the first year, 2% the second year, and I'm 1% the third.
Yeah, that's why it's a 3-2-1 buy down.
Yeah. I just broke it. 3% the first, 2% the second, 1% the third year.
And then year 4 to 30 would be at that higher rate. But of course, within that time, like Gianni said, we're looking for those
refinancing.
Right, yeah.
They're not gonna wait 3 years to do all of that. It's just getting them in the house.
Exactly. You got it. That's it. We're trying to get them into the home to overcome the payment fear. And then, what my job is to help them understand the market. High level overview. 2 or 3 weeks ago, we got the core inflation report. That regulates the inflation level in the economy. And it was 2% below. For the first time, it went down by 2%. And those reports are about 30 days behind the live economic market data. So that means that we're on the right track. And the Fed hiking the interest rate, make sure that this is important, because a lot of people misunderstand. They think the Fed hiking the federal rate is them raising interest rates. No, it's the polar opposite. When the Fed hikes the federal rate, they're doing that to combat inflation. So them doing this over the last 6 months has been a goal to accomplishing exactly what they've just done, which is lowering inflation. So if they hike the Fed rate again in December, that's probably going to be the last hike until they start seeing things level out. Because if the next inflation report comes down below again, that means we're on the right track to getting into the 5s. Most analysts are projecting within the next 6 months that we should land somewhere in the 5s. I'm thinking probably in the mid 5s is probably going to be a soft landing. So we're on that track. Regardless of your political view, the Republicans winning the House is a good thing for mortgage interest rates, and it's a good thing for real estate, because that generally means that it's going to make it harder for Washington to pass any more bills that are going to cause increased spending, which is ultimately what caused this inflation to begin with. So that's a good thing. That as long as that continues and we start seeing things continue to drop, inflation is going to become a thing of the past, and we'll start normalizing into the fives. It's important to tell your clients this, because what's going to happen when rates go back into the fives? Everyone's going to jump back.
Everybody's going to be jump back into a buy. What's it call it? What's that word I'm looking for?
Seller's market.
Seller's market. It turns right back into a seller's market again.
So buyers have a. Go ahead.
Where did the savings for 18? How'd you calculate 18,400 for savings? Where did that number come from?
Great question.
The whole total.
Let me jump into that. That's a great question. So that's a perfect segue. So we have this little calculator here, as you can see, same example, right? And there are 5 different temporary buy down options. There's the 3-2-1, there's a 2-1, which is very popular right now. The 1-1-1, which means their rate is lowered by 1% for 3 years. The 1-1, where their rate is lowered by 1% for 2 years, and the 1-0 just means the first year they're lowered by 1%. So this is the most popular one here, but there's a lot of different options. That's why when we get your client, we can also combine this with permanent buy downs. What I'm finding right now, if someone has, a limited amount of closing costs that they're getting in concessions, and they're not getting a ton. So we use these different programs depending on how much the seller is going to give us, right? So sometimes I'm finding that a permanent buy down of 1% and then a temporary buy down of 2-1 is making it more affordable. So for example, if they're at 6.875 and I can buy down their interest rate by 1%, that was yesterday getting them to about 6.375, then I do the 2-1 buy down. The affordability is still better, and it's not costing as much as the 3-2-1 buy down. So it all depends on the budget that they have to work with. But that's why we get in here, we use this tool, and we show them, what the difference in payments are and savings and everything of that nature. So they have different options. It just really depends on the buyer. They may not need to have that drastic of a payment reduction. They may only be looking to squeeze a little bit out and have a little bit of seller concession. So let's just look at this real quick, right? So if we're back at our 3-2-1 buy down, because we already kind of looked at these numbers, the first year, 3.875, the payments reduced by $753.77 compared to the fully amortized payment of 6.875 here, okay? The next year, they're saving $515.67 a month. And then the third year, they're saving $264.02, okay? So right here, the total payments made during the first 3 years, and then the total payments with no buy down, it's a savings of $18,401.47, which is the same amount as what it costs. Does that all make sense? Okay.
Yes.
So
just
yes.
quick, just to be clear, so temporary buy downs only sellers can pay for, and permanent buy down the buyer can pay for.
yeah, anybody can pay for it. The buyer can
Anybody
pay
can pay for it.
Well, the
But
seller can pay for it.
But temporary buy downs are only you can get from a seller concession.
That's correct. Because ultimately what they're doing, the seller is paying for their lowered interest rate for the first 3 years. So if a client were to do that, really wouldn't make financial sense, because they're ultimately prepaying for their mortgage, which doesn't give them any benefit. So it's only a benefit if someone else is floating the bill.
Why would the seller do a temporary buy down? What would be
Because
the
they want to
benefit
sell
to the
the
seller?
house.
Because they
They
want to
sell the
sell it.
house.
Okay.
Let me make sure I understand your question. Are you asking why would a seller offer this as a concession?
Yeah, for negotiation purposes, trying to get rid of the house, basically.
Well,
Yeah, this mark.
let's go back to our other example, okay? It's a great question. It's a really good question, right? So if I was a seller, right, and I was struggling trying to get buyers in the door, and I said I wanted to lower my price by about 15,000 or 18,000, whatever it may be, right? If I do that, right, I'm only saving the client about $69 a month by dropping the price. So I'm not making any great strides in helping them with their affordability, even though to the public eye, that may seem like a benefit, but it's not. That's why we really have to explain to our clients what that really means and why using money towards incentives of buy downs is more powerful for their affordability than just dropping the price. Using the same amount of money, you're saving them $18,400 in payment savings over 3 years. That's going to be more powerful than $69 a month. Does that make more sense?
Yes. And what would the temporary points be though? If the seller is going to give us a temporary buy down, what would they be giving us
So
initially if we do the
not
3, 2,
giving
1?
you this program. This program comes from us. The seller is giving you a set dollar amount. So whatever that is, in this case, the seller would have to give you closing cost concessions of $18,400. Okay, versus dropping the price by $18,400. So if you were negotiating a deal with the seller, right, and the seller was willing to give you $18,400 to a buy down or to drop the price, and a buy down is just a fancy way of saying closing costs. That's all it is. It's just extra closing costs. So a seller's saying, I'm going to give you $18,400 for closing cost concessions, or I'll drop the price. You're going to want to take it to use it towards concessions to buy down the interest rate, because it gives your buyer more buying power and a cheaper payment overall than if they just drop the price. $69 compared to, $754 in the first month is a nominal difference in savings, and it helps your client overcome the fear. And again, we come back to this same example, is that yes, they're buying a house for $425,000, but they're getting it at a payment with a house that costs $304,000. That's what resonates. So you're chipping away at the affordability of what it costs, and that's why it's more valuable at the end of the day. Does that make more sense?
Yes, that makes sense.
And then on the seller side of it, like the listing agent, to the seller, whether they take it off the price or give it in closing costs, it's the exact same for the seller at the end of the day. So it kind of works out. And then also, Gianni, let's say for instance, we go under contract and we get the house and it appraises for $15,000 more. We can ask the seller then, hey, give us the extra $15,000. It's a wash for the seller, but it will make a huge difference for the buyer.
Exactly. And here's the other thing, just from marketability standpoint, I mean, all of you guys are in control of driving the pricing in the market. We don't want our sellers to drop their prices too low, because then it makes it harder for the next house in the neighborhood to sell. So if you can maintain the comparability of the prices and still give a nominal benefit to the buyer, you're accomplishing two goals at the same time. So that's
you don't want
really...
to
Go ahead, Dark Force.
I was gonna tell you, you hit it on the nail. You don't want to, it's like you're diminishing the value of the properties in the area by dropping down the price too low.
Yep, exactly. Diminishing returns. So this is these have been around forever. We're actually just created the 321. So we're one of the only lenders in the nation that have this. So you have a very powerful tool. I would say that more builders are offering higher concessions, but it's all in the negotiation. So if your client is experiencing payment fear, the best thing to do is, I'm not expecting you to understand all this or know all this. I just want you to have a grasp of it, so that if you've got a client that is payment sensitive or has a fear of payment, drive them to me, because we have options that can show them how to afford more house and not have to worry so much about rates. People watch the news, people watch the internet. There's a lot of bad data on there, and people start there to get their information. So we already have, hurdles in front of us before we even get on the phone with the client. So I want you guys to have something to combat them with and say, no, that's not correct. We can actually help you get into a payment that is comfortable for you, that would be comparable to where the house prices were, even where the rates were at 4.5%, I can still get you into something by using creative financing. That's the word you need to use, creative financing. That says everything, right? But it says nothing and it says everything.
I think that's huge, Gianni, that when we're working with our buyers, and we've said this before, when you work with your buyers, when we say where do you want to be monthly? Where do you feel comfortable in your monthly? Not where do you feel comfortable in an interest rate or where do you feel comfortable in price? None of that matters. It's where do you feel comfortable per month? And once we can get that number from the buyer, then we can partner with Gianni and say, hey, they feel comfortable at, $1,600 a month with these creative financing options. What could we do? So when we work with our buyers, make sure we still stay focused on that monthly payment, not the interest rate, not the price, because we can work on that.
That's exactly right. And, on top of that, this window that we have right now is probably 6 months. Like we were saying before, once the rates slowly slide into the 5s, all the people sitting on the fence are going to come back in the market. And you guys know better than anyone, we still have a short inventory supply. That's not going to correct itself anytime soon. So we will end up back in, a very probably intense seller's market, probably by, March or April of next year. So we have to really emphasize that buyers have a great opportunity right now to really get something where it will be affordable, because even if rates drop back into the 5s, but we have an insane market again, their payments ultimately could be higher, even at a lower interest rate, because those prices are going to continue to go up. And sellers are going to be less apt to give concessions away. So then it puts them in a worse position from affordability standpoint. So honestly, buyers have a great advantage to go in there and get something really affordable and start gaining equity as well.
I hope y'all really caught that. I really need you to understand that, because right now buyers think it's not a good time to buy because of the interest rates. But you got to think about the price of the house. Right now, I just talked to Brenda. She's got 8 listings. She got 3 or 4 price reductions yesterday, right? So sellers are feeling that pain. So as a buyer in this market, I can get a house. I can get the seller to give me some stuff, give me some money because they're sitting on it. And I can get in at that lower rate, lock in my home price, and then still have the lower rate and have 3 years to refinance. And we already know it will probably happen way before then. So the option is buy a house now, right? With the seller willing to give, willing to negotiate, and you lock in that house price, or you wait till next year and then the sellers jack the price back up and they're not giving no concessions. Yeah, you got a lower rate, but now you're paying $50,000 more for the house, just like that first slide that Gianni showed us. So y'all get that, right? You got to be able to express that to your buyers. Hey, I know you think the interest rate this and, and prices are coming down. Now is the time to snap it up. Now would be the best time. Don't wait till there's 400 buyers in the market during springtime. As soon as that income money come back, everybody buys a house in March and April.
That's exactly what I said. When Gianni said March, April, I was going to tell him, what time of the year is that? That's income tax time. Everybody's rich.
It happens every year in real estate. We start booming in the springtime because people, they over the hurdle of spending all that Christmas money. They got the money in their hand. They're ready to buy. So we got to be able to talk about it. Anyway, I just want to make sure we pick that up. Okay, go ahead.
Absolutely. Yeah. And then, I have flyers here that I can share with you guys that will kind of paint a more simplistic picture of this, just showing people what it is, what we have, the 3-2-1. This kind of gives everybody an overview of all our buy down options. The only one that's not on here is the 1-1, but looks like they're right out of space. But 3-2-1, the 2-1, the 1-1-1, and the 1-0 buy down. So just kind of gives people something new, because what we want to do is we want to get people excited again about the market. So if they feel like there's a tool out there that can help them get into a better payment, then get them to me and let me do, the deep dive of it. There's another flyer. I just want to show these to you so you can see that we have some stuff already in the works.
So guys, think about what if you had put something out on social media or sent something out to your database to say, hey, wow, get with us about creative financing options. You could buy a $400,000 house at a $300,000 payment. Ask me how.
Exactly. That's it. Just those buzzwords, just like Alicia said. Don't try to explain the math, right? Because that's going to go over everyone's head. But that bullet point right there, buy a $425,000 home with a payment equivalent to a $300,000 home.
Ask me how.
Ask me how. Right?
And then we're going to send him to Gianni and he'll tell him how.
Exactly. Yep. And this is one for listeners.
Gianni.
Yes.
Can I get that flyer, bro?
Yeah, I was gonna say I'll have all these available for you if you guys want to do co-branding. Some of you I have pictures of, some of you I don't, but essentially I'll get these out to Alicia, and then you just pick me up with your headshot and then your contact information, and I can have these whipped up in 24 hours.
All right, G. I think you already got a headshot of me.
I think I do.
Jill is on. Jill, can you keep track of who's on this Zoom and make sure that Gianni gets all their headshots and contact info? Thanks.
G, if you don't have one, I'll send you my a new picture because the headshot I got probably got my hair. I don't want that one.
Got it.
Side note, guys, I'm going to be bringing a photographer in probably the end of December or maybe beginning of January so everybody can get some new headshots. So we'll be bringing a photographer in. So ladies, okay, make sure you get it because we're doing some new headshots.
Yes, indeed.
Everett, gonna line that thing up, okay?
Absolutely. Awesome. Well, guys, I appreciate it. Did any of you have any other questions or any other challenges that you're facing out there?
G,
Yeah.
So I want to ask you. So I had somebody that tried to come back with me when I was explaining to them about that 3-2-1 buy, and they were like, it sounds kind of like a adjustable mortgage rate.
Great point.
Right,
yes.
right. I hit the nail on the button, right?
Yes, you did. Because a lot of people are throwing out adjustable rate mortgages right now, and honestly, unless you're going with a credit union, the adjustable rate mortgages out there are not pricing out any better than the 30-year fix. So a 5-year ARM or a 7-year ARM, unless you're doing a jumbo mortgage or working with a credit union, it's not really sustainable. There's no real feasibility out there. But because that's been mentioned and it's been brought into the market, just like Everett said, a lot of clients, when they hear this, they automatically think it's an adjustable rate mortgage. So that's the most important thing. And you might want to say that this is not adjustable rate mortgage, that this is a temporary buy down. So you know what your payments are going to be. There's no risk in fluctuation. You know exactly what your payments are going to be throughout the entire life of the loan. With an adjustable rate mortgage, there's some uncertainty once you go past that fixed year period where your rate's going to end up. So that's the big difference, and that's kind of a very short synopsis of you want to kill that right up front, because we don't want people thinking we're trying to sell them an adjustable rate mortgage, because there's a bad connotation of that whole stigma.
And with adjustable rate, right? But you said they have to. It's after 6 years. That's when their rate will change.
It depends on the type of adjustable rate mortgage. They're all different types. There are 3-1s, 5-1s, 7-1s, 10-year ARMs. So it just depends on how it's made up. But yeah, it can be fixed for any length of time, and then after that fixed period, it becomes adjustable. So like a 3-year ARM is fixed for 3 years, and then it becomes adjustable for the remaining 27 years. 5 years, it's 5 years fixed, then 25 years they're adjustable. And the adjustments happen once a year, and most of them usually have a cap of 2% per adjustment, meaning every year it could go up a max of 2%. That's a death sentence in itself. And then a cap of 5% over the life of the loan. You think about a 5% jump, right?
That'll put them out the house.
They'll put them out that. Well, let's go back to 2008. Let's go on our time machine back to 2008. that's what killed the mortgage market, was adjustable rate mortgages, along with other things, but that's ultimately what caused people to not be able to afford their homes. Other than mortgage fraud, there was a lot of adjustments that started to happen. But that is the program and that's why they went away. There is a place for them, and they're in the jumbo market, because most people that have a jumbo loan, which is anything over 700,000, typically when you earn a jumbo mortgage, you're more apt to refinance more consistently, because even a half a point drop in rate could save you $400 or $500. So there's a nominal difference when you use risk on an adjustable rate mortgage. They're just more geared for a different market. So the only time I saw adjustable rate mortgages benefiting a client was right after 2008, when the rates jumped into the sevens and they hovered there. They came out with some aggressive adjustable rate mortgages. The reason why they're not pricing out better right now is because the secondary market that buy these mortgage coupons, they're not seeing any longevity for that program, because they know that the market is going to change in the next 6 months, and that rates are going to settle down into the fives. So there's not going to be any desirability and not enough market to create that desirability from the bond standpoint. So that's why there's no attractiveness to that, because in order to do an adjustable rate mortgage, you'd want the interest rate to be 3 or 4% below where the market rate's at, because then you have enough fluctuation built in there in case it over adjusts itself, to be able to say, okay, I'm going to level out at the market level at my worst case scenario. It's not there. In fact, the pricing is almost worse in most cases, so it's not worth the risk.
Another quick thing just to throw out there, what's the most amount of money that a seller can contribute to a buyer in a purchase?
It's a great question. So if you're using just the minimum down payment, because it can fluctuate if the client is putting more money down. So if you're putting minimum down payments, and again, I'm sorry, these temporary buy downs can be used for conventional, FHA, VA, and USDA products, okay? So all four. Now, we'll go through the different concession restrictions. For VA, it's 4% of the sales price. FHA is 6% of the sales price. Conventional is 3% of the sales price. However, if your client puts down more money, the concessions can go up. Meaning if your client puts 10% down, they can go up to 6% in concessions.
And then USDA?
USDA is 3% as well. They follow the conventional model.
So 3% US, 3% conventional, 4% VA,
6%.
and the worst one, 6% for FHA.
That's good.
That's the best one.
That's the best one.
Yeah, but that's a lot of money. That's a lot of money to ask a seller for.
No. Not how much it costs. Remember, Ev, we were talking the other day about how much the seller can contribute to the buyer's closing.
Okay,
the
okay,
most
yeah.
that they can contribute is 6%. Not saying that the buy down costs 6%.
No.
Yeah. I was getting it. I'm getting confused with the buy down. We're talking about.
We're talking about, just so you know what you have to work with, depending on your client, you know how much money you can ask the seller. So most conventional clients are more than likely going to fall in that 2-1 buy down category. FHA and VA are going to be better fitted for the 3-2-1 because they have the ability for the seller to pay that amount of money. So that's why we're trying to kind of break this down, because certain buy down products are going to be better fitted for certain clients.
So I just want to run that back for everybody. What I was asking is, like, let's say if you have an FHA buyer, the most the seller can contribute in closing costs, and no matter how they use the closing costs, whether it's a buy down or for actual closing costs, the most they can contribute is 6%. With conventional, if they're putting the minimum down payment, the most they can contribute is 3%. So for example, that house that's $425,000, if it was FHA, the seller can contribute up to $25,000. right?
Mm-hmm.
But if
Yeah.
it was conventional, they can only contribute up to 12,750.
Mm-hmm.
So let me put it this way, Ev. Okay. So let's say at 425, we get the seller to contribute 3%, which is 12,750. But we need 18,000 for this buy down.
You rate them drop. You
We
gotta
need
get them to drop
increase
the price.
and roll that in, right, Gianni?
Correct.
That's not how
You get what I'm saying?
you said. Increase the price.
Can't we increase the price and then roll that in?
Yes, so what she's saying, Everett, is like, for example, if you wanted to get more closing costs paid by the seller, and the seller's bottom line is drawn out by the price you're at right now, but we know the house is gonna be worth, let's just say we need an extra 10 grand and we're at 400,000. We can raise the price to 10 and then give an additional $10,000 back, because the seller's still gonna net the same thing. You're basically financing your closing costs. That's the way you gotta look at it. The buyer's essentially financing the closing costs because they're building it into the price model.
So, like for example, like my house, I had got $20,000 for. So I had got $20,000 off of closing costs, and I only could have used because 3%. So it was $9,000 at the max I could ask for the house. So what we did is that we made them drop the difference in the price of the extra 10,000 and change. So you saying that I could have made them go up an extra 10,000 and change?
Oh, no,
and take
wait.
it off them.
No, we're talking about two different things. You're talking about, we're talking about when, like, when we're negotiating a deal and you come to a bottom line where the seller's drop dead point is, not gonna move any further because they're gonna want to net out a certain amount of money, but you haven't reached the goal of closing costs to get the buyer what they need to get their payment in line. What we're talking about is that we can raise the price. We can't change the percentage on the concessions. That's going to stay the same. But when you do bring the price up, it does allow more money because the percentage is based on the sales price. So if we bring the price up, it increases the amount of closing costs. But in your example, you're kind of in a juxtaposition because you have to kind of figure out, because when you drop the price, then you also drop the percentage that's allowable for concession. So you kind of have to make you did the right thing. You kind of have to kind of meet in the middle and have a median. So
basically, it boils down to this. If you have any question about how much, you call Gianni, okay? He will break it down for you and give you exactly what you need and what we can ask for. So that we
can
can
get confusing, as you can see. So there's a lot of numbers and all that stuff. Like I said, that's really what I want to do for you guys is help you guys on that end, so you don't have to worry about that. Just get the clients excited about it. Tell them there are ways to combat affordability, and then the market is a perfect time for buyers right now. Don't wait, because it's going to end up costing you more money. It's a great opportunity to get an affordable payment comparable to what it was at the beginning of the year with the tools that my lender has to get creative financing.
So just to recap, if you're working with buyers and they're giving you the objection that, oh, I don't want to buy right now because I want to wait for the interest rates to go down. I don't want to buy right now because, I'm waiting for the prices to go down or whatever. Or I don't want to buy right now because whatever their objection is when it comes to the money, pricing, financing, anything like that, just let them know, hey, acknowledge it. I understand that, you have some concern about the interest rates and purchasing a home and this, that, and the third. What if I could tell you, you could buy a house at 400, whatever example, 400,000, and have your payment be like a $300,000 house? How would that?
That's all you got to say.
That's all you got to say. And then they're going to be
the
like,
next question, how?
How? You call Gianni. That's how. You call Gianni and he'll tell you how. And then you link the two together. Does that make sense, guys?
Well, you got to do some type of a little explanation before you call
Yes,
Gianni.
that all makes sense.
You can't just throw it on them, because they're going to want to know, what are you talking about?
Well, of course, you're going to call Gianni and say, hey, I just told somebody about that thing you told us about the other day. Of course, call Gianni and give him a heads up that you're connecting him with a client. But I'm saying,
we'll break it down though, at least.
Don't break it down too much if you don't understand.
Don't break it down too much if you don't understand it. Yeah.
Because when you
Well,
start saying a whole lot of words, it'll confuse them.
Right. Yeah. What you don't want to do is you don't want to set them up with the wrong information, because then that makes it harder for me to dive into it and explain them. I want you to use buzzwords and get them excited enough to pass the buck over and say, listen, numbers aren't my thing. That's why I have a lender that has 22 years experience. Let me get him on the phone with you and he can explain everything. So you're not saying I'm not answering your question, but he can answer better for you, because I don't want to, I don't want to confuse you. I want to get you the right information and get it to you. But he does a great job of explaining it.
So you could,
Give me that
so
opening.
so you could say, hey, you can buy, you could do the price one where it says you could buy a $400,000 house with a payment of 300, or you could say, hey, well, I don't want to buy a house right now because the interest rates are so high. They're at, 7%. Okay, well, what if you could buy a house and your interest rate was 4%? Would that be interesting to you? Would you like to know more about that? And then pass it off. So it could be, if their issue is price, you could say the price one. If their issue is interest rate, you could say the interest rate. Okay, well, I understand you're concerned about these interest rates, being at 6%. What if the first year your house payment would be at a 3% interest rate? Is that something you're interested in? Would you like to know more about that? Of course, they're going to say yes. Great. I'll connect you with my guy, Gianni. He's going to help break it down for you and see which ones you qualify for.
And another thing, I think the most important thing is, I think you want to steer them to answer the question. Whatever they're saying, Alicia just said 3 different things, but what did she say? We're all coming back to the same thing. Mr. Smith, it sounds like your concern is about affordability. It's about being able to comfortably afford a house that's going to meet your needs in this market. Great news. I've got a lender that has all sorts of different tools that can help you get into the home that you want without having to pay more than what you are comfortable paying. That's it. Don't talk about rate. Don't talk about anything else. You want to take them off that. If you start talking about rate and everything like that, that's what they're going to be fixated on. So you have to get them off that and get them to understand that their problem is not rate, it's not price, it's affordability. And if you can get them thinking about that, then that's all they're going to think about. When I get them on the phone, they're going to be off the rate, they're going to be off the price, and then I segue into what I'm doing. That's going to be a better way of getting them to me than giving them the answer that they want to hear. Because when you give them the answer that they want to hear, the problem is they're going to still be fixated on that issue. We want to change their dynamic of thinking to tell them what their problem is. Our objective is to share with them not what they think, but what exactly it is that their issue is, which again is affordability. That's what everyone's fear is. You can even say, hey, I understand your fear. That's what we're dealing with right now. Everyone's fear is the affordability of housing. Well, great news. I've got a lender that has all sorts of unique products and tools that help you afford the home that you want. That's it. Leave it at that. Some people will come back with more, but the bottom line is you want to keep it as light as possible, and you want to hit the objective and tell them what they're thinking. Because then if they resonate with that, more than likely that's ultimately what they are thinking. They just don't know how to translate it to you. So if you give them that answer, they're going to say, all right, this guy knows exactly what I'm thinking. This is fantastic. And that's enough for them to trust you to move on to the next. It should be. Because when I have these conversations with clients and I start talking about that, they're like, that's exactly what I'm worried about. Because they don't really know what an interest rate does. They really don't know what a $20,000 price reduction does. They don't understand that. It's a big number and it sounds cool, but they really don't know what that means to their budget. What are they stroking a check for at the end of the day? That's our job, is to get them to understand that. That's why, Alicia's bullet point, the one that we had up here, I'll bring it back up here. All this math really comes down to this. A 3-2-1 buy down saves the buyer almost $750 a month compared to a straight buy down or price reduction. And this is the selling point. This means a buyer can purchase a home for $425,000 and get the same payment affordability of a home that costs $304,000 for the first year using a 3-2-1 buy down. So that's really the takeaway out of all this, and that sums it up for them. So we want to shorten it. We want to keep it short and sweet and not give them too much to think about, but focus on the affordability. The biggest issue that all buyers are facing is affordability.
That's the word of the day, y'all. Affordability.
No.
Affordability. Okay. And then also we need to
Hold on. There's 2 words of the day. Creative financing.
Creative financing.
That's the most important thing to talk about, because as soon as I use that in my text message.
Right.
So that we have lenders are doing creative things to help buyers with their monthly mortgage. As soon as they see that, they're like
affordability.
With their monthly mortgage affordability, whatever. But that's how I catch them.
So we got creative financing, we got affordability, we got helping people be able to reach their goal. And their goal is not to purchase a house at a 4% interest rate. Their goal is to have a house because their family and whatever their big why is. So we got to make sure that we don't stay down that financing bucket with them when really their big why is a whole different reason. That's just an obstacle and an objection, which we can easily handle with the words creative financing and affordability and those kind of things to help them get to that big why, right? So make sure we're focusing on the big why, helping overcome the finance objections with creative financing and affordability. And we're partnered with one of the top lender, the mortgage godfather. Okay, so he will make sure to get you what you need, right? So what do y'all think? Thoughts, questions, feelings about this? I think it's fantastic. Get into it.
Amazing class. Thank you, Gianni.
Awesome.
Yes, thank you. That was very amazing. I wrote down a lot of notes.
Awesome.
Yeah, you just gave me some ammunition.
Yeah, you really did give me some ammunition now.
So don't have any fear when you're talking to these buyers. Creative financing, affordability, what's your big why? We can help you get there with our trusted partners. This was so good. I feel so happy being back and seeing all your squares and all that. I forgot my money thing, my money staying at home, but I'll bring it back tomorrow. But any of the last thoughts, questions, feelings, Jill, we'll get that over to you, Gianni, all the headshots and contact info and logos and stuff, and we'll get those flyers to you guys so that you guys can use it. Start talking on your social media, start putting it out there. Hey, you want to know about creative financing? Hey, you want to know how to get a $400,000 house at a $300,000 payment for the first year? Ask me how. Right?
Yeah,
Okay.
I'm gonna start doing some more videos on it as well that I'll share with you guys that you can use content for your social media. So I'm planning on rolling out a series of videos this week.
Nah, I got something better, G. We're gonna talk after. I have something better than that.
Okay.
And call Gianni. Anybody else? Last thoughts, questions, feelings? All right, guys. Thank you so much for showing up today.
G,
we appreciate it.
I got a question. Yeah.
Yes.
So, how would you battle somebody saying, "All right, Gianni, there's all these programs like Bank of America has this new program for Blacks and Hispanics and what you call it? Legacy Loans has this new 1%. So how is this 1% down to get into the home and stuff like? So how does this 2-1 buy down better than those options?
I mean, every builder is going to have their shiny little toy, right? If you're not a preferred lender of the builder, and they're not allowing outside.
They're not a builder, G.
No, this is Legacy Home Loan. It's a mortgage company.
Oh, Legacy Home Loans. Bottom line is that I gotta understand what the promotion is, because a lot of times people will throw lipstick on a pig. It's the same pig. They just dressed it up fancy, right? So that's where you kind of have to dive into it. So if I were you and you really want to understand what it is, get on the phone with the loan officer and get more details, and then come back to me, and then I can tell you what it really is, and if it's something comparable to what we have. The only ones that, and I'm going to be completely transparent right now. The only ones that can really create product and program that's outside of the retail space is local community banks and credit unions. And the reason being is because they get a certain amount of federal money from the government where they have to do creative financing to lend that money out, because if they don't, they lose it. So I know, I think it's Navy Federal or USAA, they have a 100% conventional program. The interest rate's through the roof. So you got to look at it from that perspective. Great. Okay, what if we were to give you, what if we got the seller pay all the closing costs and you did a 3% down payment, then your payment's going to be better. So you're saving the same amount of money because, at the end of the day, it's all about not only affordability, but out of pocket too. So sometimes I've been able to combat that with just getting creative and how we set up our financing, because at the end of the day, people's objective is money-based. So the other problem with those lenders is that when we start getting into more competitive space, sellers are not going to take credit union pre-approvals, right? We all started seeing that at the beginning of the year. So me being a local lender, appraisals are going to be even more imminent now that prices are starting to go down. Be prepared in the next 6 months, you're going to have appraisal troubles, because the flip-flop and the comparabilities are going to make it a little bit more challenging for appraisers to find some stability in the market, especially when people are start bringing their prices up. So having a local lender that knows the market using local appraisers is always a good selling point, and also control of the loan file and closing on time. Programs are as good as the lender that they're backing it up. It's like having a Lamborghini without an engine. It may look sexy and pretty, but if you can't drive it, it doesn't go anywhere, right?
But I know what you're talking about. And so like Gianni said, talk to that loan officer, get those details, and then run it by, because, I've heard of those, but I ain't seen nobody close one. I ain't heard nobody close one.
I mean, a lot of lenders will use programs that are very difficult to qualify for as a way to get you interested in speaking to them, and then they switch it up. Oh, yeah, you don't qualify for that. So it's a shiny little thing to get people excited, but it doesn't mean that they're ever going to qualify for it. So usually, if it sounds too good to be true, it usually is, especially when it comes to these low down payment programs. They usually have a ton of overlays and guidelines to try and fit into them, because you got to think of it from a risk perspective. If I'm putting less down and it's not your traditional USDA or VA, then they've got to come up with something to incentivize the investor, who's the person that's lending the money, to take on that risk. Because 9 times out of 10, you have the most first year defaults with down payment assistance and low down payment programs. And that's why they kind of disappeared during the pandemic and during tough economics. So it's one of those things where we have to educate the buyer, and just because it's offered doesn't mean that they're automatically going to qualify for it. And that's the mentality that they're trying to drive home, is that, oh, everybody can get into this, but that's not always the case. So it may sound great, but it may not be something that's for them. And again, it may not be all it's cracked up to be. There's always fine print to all these products. So the best thing to do is find out more about it, Everett, and then I can kind of explain more about what it does and if it's something. I'm not going to say we have everything better than everyone. There are some lenders that have some unique products out there, but it usually comes down to credit unions and banks. And we can blow them away with service, speed, and control.
Oh, Gianni. Okay, so we're at the top of our hour. Any other questions, thoughts, feelings? If you do have any thoughts, questions, or feelings that you think of after, go ahead and reach out to Gianni. He'll help you out with that. And other than that, today is Tuesday, still at the beginning of the week. So let's make sure we get our 20 contacts in every day. And I look forward to talking to y'all soon. Have a great day, y'all.
Bye, everybody.
Have a great day, everybody.
Bye.
Bye.
Bye.